Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canadian retail sales rose 0.9% in March, but surging gasoline prices appear to be increasingly eating into household budgets. Retail sales rose 0.9% in March, and Statistics Canada is estimating sales rose another 0.6% in April. In March, sales were up in 4 of 9 sectors, led by a 12.4% increase at gasoline stations and fuel vendors. Excluding gas, though, retail sales dropped 0.2%. Canada's media regulator has unveiled new rules requiring streaming platforms to devote a larger share of their Canadian revenues to domestic and Indigenous programming. Under the CRTC's new framework, online streaming services will be required to direct 15% of their Canadian revenue towards supporting Canadian content. Traditional broadcasters will see their minimum spending requirements lowered to 25%. And Tim Hortons is ramping up its Canadian expansion plans with parent company Restaurant Brands International aiming to open 80 new restaurants and renovate another 400 locations by the end of the year. The company says population growth and expanding suburban communities have created room for additional stores. The franchise is expected to invest a combined $400 million into the new additions. And we're keeping an eye on U.S. futures this morning. The S&P 500 heading for its longest string of weekly gains since 2023. You can see in early morning trading it is up, as well as the NASDAQ and the Dow. And we're keeping an eye on the TSX as well. We'll show you how it finished yesterday. You can see it was above 34,000 points to finish the day. The S&P 500 on track for a winning week as investors show enthusiasm over AI, aerospace, and other emerging tech. So let's get some perspective from Young-Yu Ma, Chief Investment Strategist at PNC Asset Management Group. Great to have you. Good morning.
Thanks. Good morning, Lindsay. Great to be here.
Yeah, I mean, this is an interesting week as always. What's your take on the direction we've seen with the markets this week?
Well, the equity markets have been pretty sensitive in the U.S. and globally to an extent, been sensitive to yields, particularly longer term yields. And I think that sensitivity is going to continue. We're at a range here where the market is starting to get cautious with any rise in yields, and it gets a little bit more excited or enthusiastic with any decline or reduction in yield. So, of course, that's tied to what's happening in Iran, oil prices, concerns about inflation, and what the Fed might do. It's all tied together, but I do think that yields are going to be a sensitivity point for the markets in the short term, and that we've seen at least a little bit of backing off of those yields have allowed the underpinnings and the fundamentals of the markets at least to sustain that upward tilt in the markets this week as well.
Okay, so you say yield sensitivity will continue. Do you feel as though maybe investors are becoming less sensitive to headline news?
Well, I think investors don't know quite what to make of some of the headline news. There's so much back and forth, particularly about whether or not there may be a deal in Iran, what the contours of that deal might be. I think that at this point, there's some knee-jerk reactions, certainly, to those news items that come out. But I don't think there's the intense focus that there once was on those news items. And the belief in the market right now is probably still directionally we're looking at some sort of deal. And so if we didn't get anything, I think the markets would be disappointed. But there's a lot of uncertainty on what that deal would look like.
Yeah, it's hard to know at this point, as you say, because it sounds as though we've been close to a deal before and then it didn't happen. So we'll have to wait and see on that front. But when it comes to tech, it seems investors showing some enthusiasm over AI, aerospace, other emerging tech. What are your thoughts on the tech sector right now? Is that a good place to be?
We do think it's a good place to be. We think this cycle, this investment cycle, CapEx cycle, has a long way to go. You talked about the consumer retail sales. We think those are set to soften because of inflation and higher gas prices in the coming months. But this strength has a lot of deep pockets behind it. It has a lot of corporate cash behind it to make these CapEx investments. It has a lot of operating cash flow. It has a lot of private equity money, has a lot of debt capital it's sourcing. So we do think this is likely to continue, even though we're going to see some softness probably in the consumer in the coming months. We like tech and continue to want to lean into these themes that have done well over the past several quarters.
Were you, just to ask you about the numbers that came out this morning, because you mentioned them, were you surprised to see them ticking up?
Well, in terms of retail sales, you're talking about specifically?
Yes.
I think we're going to see softness going forward. I'm not too anchored on the current numbers, and that applies to the U.S. as well, because there's some overhang or momentum from some of the strength that there was previously in the year, but I think that's going to wane in the coming months. So I think when we're looking at what's likely to happen next month, next quarter, I think there's going to be a drag. And I think we're seeing that in some of the dispersion in the market. We're seeing some major companies in the U.S. talk about, some major retailers in the U.S. and staples companies talk about the challenging environment that is for consumers, and talking about cutting prices amid a time when inflation, the underlying cost pressures are actually going up. So I think that's a sign that they're seeing a lot of incipient pressure there at the consumer level. Yeah,
and it has been interesting when you're seeing some of these retailers reporting earnings, talking about, high income spend shoppers compared to low income shoppers. There's quite a gap there, quite a discrepancy. I wonder what that tells you about the economy, as you say, moving forward, maybe a little gloomier.
Well, I think it's going to continue and probably get worse because, of course, higher income households are less subject to or have less pressure from the higher energy prices. It's just a much smaller share of their wallet and discretionary spending that gets used up. So I think we're going to continue to see that. I think it's probably going to get more extreme in the coming months and quarters, that dispersion among consumers. So you see some companies that are seeing gains or benefits from higher end consumers and higher end purchases actually doing reasonably well, where those that are more reliant on middle income and below seeing signs of pressure. I think we're going to see that. We're seeing that in company narratives as well coming out.
For sure. Okay, I want to go back to the markets in certain sectors as well, because we were talking about AI and tech. Are there other themes emerging in this year's markets that you're watching for that you find interesting?
Well, there's some adjacent areas to that we think are going to be quite durable as well. So if you think about what are some implications of the tech build out, or what helps to benefit or sustain that, we do think that clean energy and energy security globally is going to be an important theme. The infrastructure to support that, those are going to be important themes as well. Once we start looking a bit deeper, there's a lot of sectors had negative earnings revisions in the U.S. after their Q1 reporting, and we think that sign of dispersion is showing that it's not a uniform lift all ships, especially when we see these cost pressures. I think if we want to look at more areas of opportunity, you have to get a little bit more targeted. I do think there are some areas of opportunity. You heard the airlines in the U.S. talk about, for instance, how bookings have been very strong, but you're starting to get into a little bit more niche areas rather than very broad sectors.
Any areas then that you are maybe thinking to avoid right now? Is retail one of them?
I think consumer staples. You had two very large companies, Kroger and Walmart, come out and talk about cutting prices to try to gain market share from some of the other strong players in either the discretionary or staples sector. I think in terms of profitability, you don't like to see the beginnings of what might look like a price war, especially when cost pressures are rising. You like to see some pricing power if you're thinking about the bottom lines for these companies. So I think it's going to take some time to work through these cost pressures and stabilization of the consumers to digest these higher prices that they're seeing at the pump and at the grocery store and other places. So I think those areas you want to be cautious on over the next couple of months here.
Okay, we will leave it there. Young-Yu Ma, Chief Investment Strategist at PNC Asset Management Group. Always good to have you. Thanks so much.
Thanks, Lindsay.
Coming up next, SpaceX could be the biggest IPO ever. So when we come back, we'll look at some of the governance policies to know before you consider investing. Stay with us. Elon Musk's SpaceX is preparing to go public in what could be a record-breaking IPO. The company is expected to list on the NASDAQ under the ticker SPCX. SpaceX has become NASA's primary launch partner since the space shuttle program ended in 2011 and now sits at the center of a massive, rapidly expanding space economy. For more, we sat down with Jeff Park, CEO and director of Stack Capital.
When you have a business that has one of the biggest TAMs in the world, you're touching almost every human on the planet. There's more than 2.8 billion people that don't have access to the internet. That's a really, really big opportunity that you can go after. The guy controls the launch market. So I have launch, I have Starlink satellites, and I'm sure some of your viewers probably have cabins or cottages where you don't have connectivity. This guy is giving connectivity to the world. So being able to invest in that and be a part of that, we were early, we were around $85 billion valuation in our portfolio. So we're quite excited to see this company go public. On top of that too, like we have a position in OpenAI as well. So like both those two companies, like we couldn't be more thrilled to be invested in right now for our shareholders.
I do want to talk about OpenAI in a minute, but I want to stay with SpaceX right now because the company is pointing to a massive addressable market as big as $28 trillion. What does that number actually represent?
A big portion of that, so they merged XAI into SpaceX. So it used to be solely SpaceX. Elon had XAI, he built that, acquired Twitter, and ended up merging that into SpaceX. A big portion of that is bringing agentic AI agents to the real world. And you can see like the growth from OpenAI, the growth from Anthropic. You can see how fast those companies are growing. So a big portion of that TAM is that. But also additionally too, with Starlink and 2.8 billion people not having access into any internet, that's a large portion of their TAM as well. So he does have a very big market that he's going after with both of those two pieces.
What are some of the scrutinies coming along with this announcement right now of the IPO?
I would say some of the scrutinies is you get, okay, Elon controls the underlying company. Yeah, super voting, it's a controlled company by Elon, which I think you should have control of that company. You have basically one of the largest telecommunication companies in the world, and I have faith, I have trust in him, where he's going to take that in the right direction. So there's scrutiny there. There's also a lot of chatter around the lockups and how is that going to work. And with the S1 filing that they came out with yesterday, you can see it's a staggered lockup because the market's never seen an IPO that's this big. You're talking about raising $75 billion at a $1.75 trillion valuation. The only thing that's come close to this was Saudi Aramco, which wasn't even listed on a U.S. exchange. It was listed over in the Middle East. So there's some chatter about how are those shares going to unlock? What's that going to look like? How does the index buying look like? So that's a lot of chatter out there in the market right now.
Is that a red flag to you, just how big this IPO is?
I know everyone says it's a very, very large IPO and raising $75 billion, but the amount of demand out there for this company, $75 billion actually isn't that much when you think about all of the index buying, passive buying, active buying that need to go into this. There's a lot of people out there who they hug the benchmark, they're index buyers, right? I don't think that they're going to have no position in SpaceX. They might be underweight, they might be neutral weight, they might be overweight. But I think there's a lot of people who don't own that company that are going to have to own that company because it's going to be such a big portion of the market.
There's also scrutiny around governance policies that appear to strip away like traditional shareholder protections, including the fact that Elon Musk effectively cannot be removed. Does that raise any red flags for you as an investor?
You got when you think about this business and what he's been able to build, like we're talking about a modern day Einstein. When you've been able to build companies like Neuralink, SpaceX, Tesla, Boring Company, like having him in control of that, I have complete faith in it. And then I think another piece that people scrutinize too is the pay package for him, which I'm a big fan of individuals making a significant amount of money if they're making a lot of money for other underlying shareholders. So I'm a big fan of both those underlying components for SpaceX.
I do want to bring in OpenAI quickly. You have exposure to them as well, as you mentioned. It's been caught up in a very public dispute with Elon Musk, though, obviously, as of late. How do you interpret that situation, and did it change your view of OpenAI at all?
I wouldn't say it's changed our view of OpenAI. I would say I like that we're kind of getting this behind you. I hear a few points from Elon. Elon essentially created that company. That's another one of the companies in this world that he's created, and can he not feel so great when he feels people took that away from him and something that he wanted to be in not in basically a for-profit corporation? I can understand that. Now, do I think Sam and Brockman have built a good business off that and are capitalizing on that for shareholders, and some of those shareholders can be pensions, endowments? I am happy with that as well. So I'm just glad that the legal battle is kind of getting over that, and I'm sure there's going to be appeal over time, but it's nice to see that the ruling went in favor of OpenAI because we own both. So we're happy that that's kind of getting over it.
That was Jeff Park, CEO and director of Stack Capital. Coming up, fast fashion giant Inditex is under the spotlight. How it's staying ahead of rivals in a tougher retail environment as it celebrates 25 years as a public company. We'll be back in a moment. The global retail giant behind Zara is marking 25 years of growth as it navigates a more cautious consumer and shifting demand worldwide. Earlier, we got perspective with the CEO of retail conglomerate Inditex.
This is a sector that is changing absolutely every day. For us, has been absolutely critical and key to keep on listening at our customers, to put our customers in the center, and to improve every day, understanding what are their desires, what are their ambitions, in order to offer them the right product and the right experience. So probably going forward, the most relevant part should be to keep on listening at our customers and to try to understand what they are looking for.
So we'll talk about business and economics and even AI in a second, but maybe let's start with fashion. I mean, fashion went from quite loose and not very tailored during the pandemic to now Zara offering things that are very popular, that's more tailored, more business-like. Is that where it's going? Is that what your customer wants?
We have been considering always that fashion goes beyond transaction in garments. We consider that fashion should be aspirational, should be inspirational, and that is very consistent with this idea of providing customers any new trend and to adapt our fashion propositions to them. Maybe we should highlight also that customers are increasingly becoming more experiential, looking for a wow experience, both in the online platforms and in the physical stores.
But do you see actually Inditex just being more bold with fashion choices, especially if you look at the higher end of Zara? It just feels a lot more experimental.
Yes, well, in fact, for us, it's great to have the opportunity to provide the new fashion trends with design, with quality, with sustainability, and of course at affordable price. And that's our main focus, and our business model relies on those principles.
Does it help having actually a family member as chair and taking more risk fashion-wise?
Well, we are absolutely happy to have this nice combination of being a family-owned business that allows us to focus on the medium to long term, and at the same time being a listed company and subject to the daily scrutiny by the markets with rigor and discipline. And of course, Marta Ortega's vision is key in order to develop our strategy in terms of strengthening the level of relevance of our different brands. So we are very, very happy and very confident.
I mean, how do you think about continuity? Again, the founder and actually the family owns 60% of the company. The founder, Amancio Ortega, is 90 years old. As you're saying, his daughter is very involved in the business. How do you think about what comes next? Strategy, shareholder structure, and all of that?
For all of us, was great news. Marta becoming the chair of our board of directors 4 years ago, and that's a signal about the commitment of the family and the next generation for that medium to long term, for the long term growth of the company. Amancio Ortega, our founder, remains being a very positive and relevant influence for all of us, is a source of inspiration, of course.
You know, we were looking actually in the newsroom about all the properties that you own, and it's Zara, it's also Lefties, which is a value retail brand, it's Massimo Dutti. How do you think about, I guess, mixing the two, right? Is now the right time to expand Lefties because people will be more careful in how much they spend? Is it for a younger crowd? What's the mix and match between your brands?
Diversification is one of the key strengths of the group. Diversification from the geographical perspective. We have physical stores in 98 different countries. Our online platforms are performing in 214 different markets, and we have 8 different brands. In the case of Lefties has been selling its own collections for women, for men, and for kids for over two decades, and expanding but basically mainly focus in Spain and Portugal. So expanding the brand to another markets where Inditex has already presence is the natural step for the brand.
Where will you expand it to? Because we're looking again at the geographies. I think 60% of stores that are outside Iberia are in the Middle East and North Africa for Lefties, compared to 5% for Zara. So again, how do you look at that mix going forward?
Well, we have plans for all of our brands expanding the presence, and in fact, even in our most mature markets like Spain, we have plans for improving our physical store presence, combining with a strong performance of our online platforms. And to give you an exact example of Zara, this year we will open or totally refurbish some of our iconic and flagship stores in cities such as London, Rome, New York, or Shanghai. So many plans to keep on executing the selective growth that has been executed in previous years.
I mean, this is something that I find quite amazing, because you have these mega stores that, frankly, in London are often really, really full, where a lot of your rivals have gone online. So do you see that changing any time, or do people shop differently at Zara than they do for some of your rivals?
Well, in fact, that's one of the main changes in our industry in the last 3 decades. The online platforms. We have built a model that relies on the full integration. So the journey of our customers could go from the screen of the devices to a store, or from a store to the screen of the devices. So that's why we are looking for improving our commercial presence, larger stores, well located. And for us, the very positive performance of our online platforms is highly connected with the strong operational support that our online platforms are receiving from our stores. And on the other side, the online platforms are one of the main prescribers of our physical stores' performance. So you are right that change in the industry is leading us to look for better locations and larger stores in many cities.
Okay, the opening bells are now ringing at the NASDAQ. The Memorial Day Flowers Foundation is ringing the opening bell. At the New York Stock Exchange, American Battle Monuments Foundation is ringing the bell. And at the TSX, the Leadership Agency and Women Building Canada's Next Generation of Companies is opening the market. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we're going to check in on the equity market. Starting with the TSX, it's been seeing some gains over the last couple of days, starting the day off pretty strong, up by 0.3%. The S&P 500 also on track for another pretty remarkable run, already in the green today, and the NASDAQ as well is up as investors continue to weigh just what's going on in the Middle East, as well as what's going on here at home, particularly in the tech sector. We're going to narrow in on some Canadian companies that we're watching today. Pembina Pipeline is one. This company has signed a strategic MOU with Hanwha Power for a lower carbon power generation business. That MOU announced today, and you can see Pembina Pipeline up ever so slightly to start the morning, but it's had quite the climb throughout the year so far in 2026. IMAX is another company we're watching. According to the Wall Street Journal, this Canadian company, which does trade on the New York Stock Exchange, is considering a sale, and it has approached entertainment companies apparently as potential buyers. So continue to watch that. IMAX down almost a full percentage point to start the day. CAE is another company that's reporting earnings today with adjusted EPS that matched estimates, so kind of on par. CAE not doing well to start the day, down almost 10%. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, it's good morning. Great to see you, as always. I believe you were starting the day talking about Estée Lauder. Tell us more.
Estée Lauder, yes, that's right. Estée Lauder is the top performing stock in the S&P 500 so far this morning, and the reason is that it is calling off a merger that it had been trying to put together with a company, and I may mispronounce the name of this company, Puig, P-U-I-G. It is a Spanish headquartered and Spanish listed company, which is having a really rough day there. Estée Lauder is up 13%, and this company, Puig, is down 15% in Spain today. What happened here? These two companies were looking to put together a merger, which would have cemented Estée Lauder's kind of position and further expanded its breadth in cosmetics and skincare. But there was a minority shareholder in the target company that raised some concerns. There was also some investors and analysts on Wall Street that said, Estée Lauder's in the middle of a turnaround plan now. Not sure that it is the best time to go ahead with a merger. And so it looks like investors so far are pretty happy with the deal being called off, at least on Estée Lauder's part. We spoke, I think, a few weeks ago. Estée Lauder was laying off staff. It was undergoing this big turnaround plan. And, it somewhat needs it given the share price reaction so far this year. This is a company that is down 25% on the year coming into today. So today's 13% gain, which makes it the top performing stock in the S&P 500, is going to help it kind of crawl out of that hole a little bit.
Wow. Okay. Continuing to watch that one. You're also watching Workday. I had to look this up. It provides enterprise cloud-based applications, and it's jumping today on solid first quarter earnings results. Tell us more.
That's right. Yeah, this is one of those stocks that had been caught up in that software apocalypse, software as a service apocalypse from earlier this year when investors were concerned that the rise of AI and these new AI agents and bots would really eliminate the business plans for a lot of these companies. So Workday is now up almost 7% so far today. They beat expectations by a little bit, and they provided a forecast that was better than expected. Again, this is in an industry where expectations had been reset significantly lower. This stock came into the day 43% down on the year, so a pretty significant drop. What they reported today, they reported they boosted their operating margin view for the full year. They reported better than expected adjusted earnings per share, $2.66. Whereas Wall Street only saw $2.51. They also see a slightly better than Wall Street expected second quarter coming up. So a handful of things here that are causing the stock to move higher. But really, you had a stock here that came into the quarter with really low expectations, and it looks like they jumped over them.
For sure. Okay, Bloomberg's Jeff Morgan joining us as always. Jeff, appreciate your time. Thanks so much. Have a great weekend.
Thank you.
Coming up, Canadian banks are heading into Q2 earnings, trading near all-time highs. But is this just the calm before the storm? That's after the break. Stay with us. Next week, Canada's biggest banks report earnings. Despite economic slowdowns and trade tensions, stock prices are at all-time highs. But with CUSMA uncertainty and high inflation looming, can that rally last? Joining us now is John Aiken, Director of Research at Canadian Financials at Jefferies. Good morning. It's great to have you join us.
Good morning. Thanks for having me on.
So you pointed out in your notes that while Canadian economy is showing resilience, there's still a heavy cloud of uncertainty, obviously, hanging over households and businesses. What is the single biggest macroeconomic hurdle that you feel is threatening all that growth right now?
No, it really is the inflation being driven by gas prices. Right now, we're seeing that the inflation is typically just being encapsulated in gas, but as the war with Iran carries on, the likelihood of it actually infecting the broader price base is likely going to happen, causing even more incremental pressure on, as you said, businesses and households.
And you've titled your Q2 preview "The Calm Before the Storm." Very ominous. If the upcoming second quarter quarter earnings are expected to be solid, then what exactly is the nature of that storm you think is brewing down the road?
Well, I think that there's going to be a shift in expectations as we started into the fiscal 2026 for the Canadian banks. Expectation was that the first half of the year was going to be solid, as we've seen. Q1 results were solid. Expectations are the second quarter is going to be solid as well. But the market had been expecting the second half to be a lot better, leading into more normalized growth into 2027. However, as we sit here today, when the banks were reporting their first quarter earnings, the war was not actually going on. We didn't have higher gas prices, and this is now something that's going to cast a pall on the outlook, at least from our standpoint. And if the executive teams are not universally constructive on the outlook for the second half of the year, investors are going to have to shift their outlook, their sentiment, which with the Canadian banks trading at near peak multiples could actually cause some softness in the valuations. That's our concern, that the outlook for 2027 may not look as rosy, coming out of the second quarter earnings as it was coming out of the first quarter earnings.
You also say you don't expect relief on the credit front just yet, but it sounds as though you don't expect it to get any worse either. Is that right?
That is our base case scenario. However, if you're going to push me one way or the other, given the fact that inflation remains sticky, we may actually have the Bank of Canada raise rates through the end of the year, causing the outlook for stagflation. No, I actually think the risk is for higher credit costs, more so than them declining from what we've got in our estimates. That being said, though, the Canadian economy has been very resilient, more so than we would have expected. And the credit costs remain high. They're not falling off the cliff, and obviously not causing any panic in the market, because obviously investors are still willing to pay up for the bank shares.
We've been seeing Canadian bank valuations sitting at near or historic highs right now. Do you think, is that justified at the moment?
On a fundamental basis, no, we think that they're edging into the overpriced territory. However, you can't look at this in isolation, where right now money is still flowing into equities, but with a lack of breadth within the S&P TSX, the Canadian banks still are viewed as a defensive stance, even though they are exposed to credit. We also do believe that the banks in general have done a very good job in terms of improving their profitability levels. When you look at their ROEs, on top of a capital base that is much stronger than it was a decade ago. So you can take two sides of the coin. It just depends on what your outlook is for the macro. If it's going to get worse, no, they're overvalued, it's going to come through. If you think the macro is going to go into a soft landing, then no, you can justify these valuations. The valuations just may have to earn into it in earnings into 2027. And
I wonder too, are these banks all on the same footing as we head into the latest earnings period, or are we going to start to see a split between clear winners and losers?
Well, given the fact that we're still in an environment where we're not expecting strong top-line growth, they're pretty much all in the mix. However, we could probably see some differentiation in the second half of the year, depending on how Canada performs versus the U.S. or the globe, whether or not we still have resilience in wealth management capital markets. But one thing that we do note is actually there's a bit of a division within the banks in terms of returning capital, where we have three banks, Bank of Montreal, TD, and National, that have stated that they're planning on aggressively returning capital to shareholders via buybacks, more so than the peer group. And that should benefit their ROEs as they're shrinking their denominator, but also help to boost their valuations. And we'll see whether or not that actually is sufficient to cause some shift in the relative valuation multiples of those three versus the three that are not as aggressive.
I'm not sure if you want to say, but is there one that you like more than the others, or a couple that you feel more strongly? Is it TD that you maybe feel more strongly about?
We do think that TD sets up very well for the quarter. If we're going to go over the longer term, though, with a year out, we're probably going to take a much more defensive stance with either Royal or National Bank.
And which one do you think might be the loser, I guess, maybe of the big six?
Well, right, loser's probably too strong, but the one that's facing headwinds that are likely to persist in the second quarter is Bank of Nova Scotia, just as they're trying to transform their international operations largely in Latin America. We do think that they will be successful, but this is causing some headwinds and indigestion in the near term, and we see that in the relative valuation multiple and their performance.
Do you think we're kind of getting to that point where it's inevitable that we see more of a split between these banks, which have been on par with each other for such a long time now?
I may have argued that over the past decade or so, given the fact that there are dramatically different strategies and risk rewards entailing in that, but they have, by and large, traded in conjunction with each other. We do think that there's an opportunity for division, but right now, until we actually start to see better top line growth and separation in that way, we do think they're going to trade in line probably for the next 6 months or so.
Okay, so looking at your coverage, you have a hold rating across the board. So is there any specific catalyst that it would take for you to upgrade at least one of these names to a buy?
Yes, it would be a return to more normalized credit levels sooner rather than later. That would definitely boost the outlook for 2027 and ease the price to earnings multiple pressure. That being said, we could also see an even step function on return of capital, because we do think the Canadian banks are overcapitalized, even with our concern in the outlook. And I think that the return of capital story, even more so than what TD has done to date, would definitely be able to justify us increasing our target price and getting a more sizable return.
Okay, we'll leave it there. John Aiken, Director of Research and Canadian Financials at Jefferies. Appreciate your time. Thank you.
Thank you.
Yesterday on Market Call, we were joined by Gordon Reid. He is president and CEO of Goodread Investment Counsel, and he was covering U.S. equities. These were his top picks. You've got Apple, Celanese, and Visa. Today on the show, we have Martin Cobb. He is Senior Vice President of Equities at Lawrence Steinberg Wealth Management, and he'll be taking your questions on global and North American equities. Coming up after the break, one more question added to a fall referendum for Albertans. This new question is on separation. Details on that next. Albertans will vote on whether the province should remain a part of Canada when they head to the polls this fall. For more on this, we're joined by CTV's Jeremy Chiron. So, Jeremy, good to see you. Premier Daniel Smith addressing the province last night. What do we know so far about what's going on?
Yeah, Lindsay, look, this is significant in many ways. The province now will vote during a fall referendum on whether or not to stay in the province. Maybe not quite that far, because the wording in the question the Premier is putting forward is very important. Really, if you are in favor of separation, there are still two steps basically required to get there, not just one. That's because of the framing of this question the Premier put forward. I'll read you the exact framing. The question in the fall will be, should Alberta remain a province of Canada, or should the government of Alberta commence the legal process required under the Canadian Constitution to hold a binding provincial referendum on whether or not Alberta should separate from Canada? So really, it's the question before the question. That's exactly what separatist groups are frustrated about. The Stay Free Alberta group that put forward a petition that had 300 signatures proposing to put forward a question on Alberta separation. That, of course, eventually got thrown out by the courts because there was no consultation with First Nations. The group is highly critical of the Premier's address last night, calling it nauseating, or saying they are nauseated by it, and saying they are this is a cynical abuse of the people of Alberta, and raising questions about the Premier's future as a result of this. They're upset, Lindsay, that the Premier is not putting forward a simple yes or no question, but rather kind of adding a step, if you will, prior to a vote that would actually result in the separation process commencing. Nonetheless, we'll see a question added in this referendum in the fall, and that is significant in itself.
For sure. What implications are there for the rest of the country if a separation referendum were pushed to a ballot and then voted in favor to separate?
Yeah, I mean, look, I want to establish we're far from there, right? As I've touched on, there's kind of two steps still separating a potential vote on a decision that would allow for the province to separate if they were able to manage enough votes. Don't forget, there was a separate petition by a separate group called Forever Canadian that received 400,000 signatures. That petition was approved actually yesterday by Elections Alberta, just prior to the Premier's address to the province. So the implications would be significant, of course. It's hard to say exactly because we've never seen it in Canada. And so there would be negative implications. There would be all kinds of complex implications. This is a process that would take, likely years. But certainly it is one step closer to a possibility as a result of what we saw last night, which is the Premier adding a question around Alberta separation to the referendum in the fall. So a lot of questions still. I think the exact answer to what could this mean and what kind of implications could this have, Lindsay, are unclear still at this point. And I think many people just don't want to know what the implications could be and hope that we don't get to that point.
And Jeremy, just before we let you go, like, I take your point that this is far down the road, but it's interesting as Alberta pushes for this new pipeline, right? And looking for investors, you know, if Alberta is looking for capital for a project like this, it's an interesting time to even bring up the idea of separation.
You raise an absolutely great point. The group pushing for separation is a group that is also pushing for a pipeline. Part of the frustration, part of the reasoning for wanting to separate is because of what they deem to be unfair treatment by the federal government for the people of Alberta who would like to see the oil industry and the oil sands be more prosperous. And so at the same time, when you're looking to potentially build a pipeline and attract massive capital, you're not talking about a stable environment to invest capital in a province that is considering separation. So the two almost are fighting each other in a way because the instability right now in the province is likely a deterrent for people looking to potentially invest in a massive infrastructure project like a pipeline project.
For sure. There's already a lot of uncertainty out there just in general. Okay, Jeremy Sharon from CTV News breaking all that down for us. Jeremy, thank you.
Yeah, anytime.
Coming up, have the biggest gains in AI already been realized for investors? We've got more on that right after the break. Stay with us. After the huge run-up for AI stocks, many investors are wondering if the best gains are behind us. One of Wall Street's loudest bulls is weighing in. He says absolutely not. And he spoke with BNN Bloomberg contributor John Ehrlichman for this week's Ticker Take column on our website. And John joins us now. Good morning, John. So this is the fresh view from analyst Dan Ives. Is that correct?
That's correct, Lindsay. Yeah, and you're right. He definitely is one of the most vocal bulls. He's also a passionate sports fan. So when we had our conversation with Dan about what inning we're in the AI boom, he said it's very early. He says the third inning. Not that we can really quantify that, but from his vantage point, it's definitely not the fifth or sixth or seventh or eighth, which is important for investors. And when I asked him why, Dan just came back from an extensive trip to Asia, where a lot of the production behind the AI boom is unfolding. And from his own eyes, he's still seeing an environment where supply is nowhere close to demand. So how does Dan then go about thinking about how to invest in the landscape? Well, he looks at the companies behind the chip boom. He looks at some of the companies that will play an integral role in software, and he sees opportunities. So he's looking at the macro trends. Then he says, okay, what are the companies at the center of that? What are the leaders within those specific pockets of secular growth? And then how much risk are you actually taking as an investor if you're buying into the biggest names, even if they've had a run-up so far? So that's his framework for still being bullish on a lot of stocks that he covers, to your point, even after the gains that we've seen.
Yeah, okay, so sticking with the baseball analogy then, Ives has outlined his all-star lineup of AI stocks. There's 9 in particular. Walk us through maybe just a few of those.
I mean, we're getting into the spirit of summer baseball here. So, yeah, we asked him, like, if you had to bring it down to 9 companies and structure it the way you might a batting lineup, we'll tell you the top 3. I know on the website you can get the list of all 9. But lead off. He picked Microsoft, which I think is very interesting. Microsoft was one of the companies that played an integral role in kicking off the AI boom because they partnered early with OpenAI, and he still sees them as a gateway for a lot of companies, a lot of enterprise adoption of AI, and they'll do well on that front. Second, So in your number 2 spot, he likes Alphabet. I know Alphabet's had a great run over the last year as investors started to realize the opportunity. It had been long forgotten. But when you look at how they're integrating AI into their consumer offerings and the lead they've already had there, he continues to like that company. And a third, since we're also talking, I said, chips and software are a key component. As an example, on the software side, he cited Palantir, which has had a rocky year, no doubt, as a stock investment. But when you look at the Bloomberg projections going out for the next few years, they are expected to see some massive profit growth, and he just thinks that they have embraced the AI opportunity, and at least from the software side, they're likely the most well-positioned of a lot of the companies that he covers right now.
Interesting. Okay, John, thanks for that. You can find John's full story on our website and on the Ticker Take YouTube channel and podcast. Thanks, John. And we're going to take a quick check on the markets before we just go to break here. So we'll start with the price of oil, because obviously we've been watching that closely, of course, over the last couple of months, ever since this conflict in Iran broke out. It's rising after a 3-day drop, with the Iran-U.S. stand-up now specifically talking about uranium very much in focus today. The price of oil is up 1.7% at the moment, hovering just below 2%. As that standoff kind of continues, erasing any hopes that maybe the Strait of Hormuz would be reopening sooner rather than later. We're also watching the price of gold. It is edging down once again as the continued talks in the Middle East continue to keep investors guessing on rate paths, because obviously with the price of oil so high, it's potentially increasing inflation. And we'll have to wait to see what the Fed and the Bank of Canada decide to do. But gold futures down by 0.6% at the moment. And we're also watching the loonie. It is softer this morning as well. It's down by just about 0.1%, so relatively flat, but still softer compared to its U.S. counterpart. Coming up, earnings growth in the first quarter of 2026 was more than double what analysts were expecting. And we'll get more on what's driving these gains when we come back. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Canada's media regulator has unveiled new rules requiring streaming platforms to devote a larger share of their Canadian revenues to domestic and Indigenous programming. Under the CRTC's new framework, online streaming services will be required to direct 15% of Canadian revenue towards supporting Canadian content. Traditional broadcasters will also see their minimum spending requirements lowered to 25%. And Canadian retail sales rose in March, but surging gasoline prices appear to be increasingly eating into household budgets. Retail sales rose 0.9%, and Statistics Canada is estimating sales rose another 0.6% in April. In March, sales were up in 4 of 9 sectors, led by a sharp increase at gasoline stations and fuel vendors. And shares of IMAX are surging today. There are multiple reports the film distributor is exploring a sale and has approached entertainment companies as potential buyers. IMAX's search for a buyer comes as premium theater experiences are growing faster than the overall box office. Movies have grossed about $2.9 billion US domestically this year. That's the highest total for the same period since before the pandemic. And we're watching the TSX this morning. It is up, not by much, but up by 0.2%, continuing to see gains in this area today. We're also watching U.S. markets, which we're going to be talking about in just a moment. But the S&P 500 is heading for its longest string of weekly gains since 2023. You can see it's up by 0.4% at the moment. The Dow Jones also up by 0.7%. In the latest news on the conflict in Iran, U.S. Secretary of State Marco Rubio says there has been slight progress in talks with Iran. Whether these talks turn into a tangible peace deal soon remains to be seen. But our next guest says he remains constructive on American equities despite geopolitical risks and the continued shutdown of the Strait of Hormuz. Joining us now is Julian Nonowamden, VP of Equity Analyst at Goodread Investment Counsel. It's great to have you join us. Good morning.
Good morning, Lindsay.
So you're still feeling pretty optimistic. What do you see as the greatest risk to U.S. equities as the result of the conflict?
Well, I think the conflict is certainly something that's topical, but we need to step back and think about what drives equity markets, and that's earnings growth. And in conjunction with valuation. So I'd say right now, the risk to equity markets has less to do with geopolitics and more to do with the tension between earnings growth and where valuations are today. As we've seen from companies in Q1 reporting, earnings growth shattered expectations, up, call it 28% year over year. But at the same time, valuations on the S&P 500 are elevated relative to historical measures at 21 times earnings or so. So I think the valuation tension relative to the earnings growth is the biggest risk. However, because the earnings growth has been exceptional and because the outlook continues to be pretty strong on that front, we remain constructive at Goodread.
I mean, I do take your point, but we're seeing some companies like Walmart, for example, reporting earnings, and their earnings have already been affected by higher fuel costs, which are obviously a result of the conflict in Iran, right? So they are all connected. So do you expect, as you say, the S&P 500 up by 28% in the first quarter of this year? Given that and the connection that there is with the conflict, do you expect that momentum to continue?
Yeah, and I think that the Walmart example is very pertinent, and this is where we have to disaggregate the S&P 500, individual companies, and the economy. You take a company like Walmart, they're certainly tied to the consumer economy, and that's why they're seeing the effect that we're seeing as consumers. Higher gas prices, whether it's here or abroad, is certainly having an impact, and that will consequently affect the likes of Walmart. But if you step back and you look at the S&P 500 and its largest constituents, which are predominantly technology companies, communication services companies, and to an increasing extent, industrial companies that are benefiting from a generational investment cycle in AI-related products, there the earnings growth has been strong, and we expect it to continue to be strong. So I would caution viewers to sort of look at the market and the economy as related, but not necessarily overlapping.
Okay, so let's talk about that a little further. The AI growth and the spending that we've seen that's been driven largely by, AI spending. What is the market rewarding the most at the moment then? Is it growth, margins, cost discipline? What do you think it is?
Well, I think it's a combination of two things. It's certainly growth. That would be number one. It's growth. And then the second is, with that growth, the expectation of higher margins, which translates into above revenue growth, earnings growth. a bit of a full word there. But earnings growth is ultimately what drives stocks. And where we think the areas of opportunity is starting to think in the second and third sort of order effects, not the immediate spenders, but companies that are going to benefit from that spending. We've seen it in areas like power. We've seen it in areas like memory. And we've also seen it in an area that we like particularly, which is the industrial sector, broadly speaking. And so companies that are going to be recipient of AI fuel demand. As a result of that, they likely have a pricing tailwind, which will then lead to strong earnings growth.
And when it comes to the areas of the AI boom that you see the most opportunity, what are they? Like, is that power, networking, memory? What areas?
For us, it's a combination of power. It's a combination of just broad industrials. We've found the industrial sector as a whole to be an incredible source of opportunity, not just this year, but last year as well, and even the year before.
Okay, we've got some stock picks that we want to go through that you like right now. We'll start with the first one, Regal Rexnord Corporation. Tell us more about this one and what opportunities you see.
Yeah, so Regal Rexnord, it's a diversified industrial company. They effectively create systems and subsystems that do one thing really, really well, which is convert, transmit, or apply power quite well. And what I mean by that, if you're at an airport, the conveyor belt, the power system that makes that conveyor belt move would be something that could be powered by a Regal Rexnord system. Now, the applications are diversified across the economy, but they have an emerging data center business, which is pretty small today, but we think it can increase substantially over the years ahead. The company is also tied to broad industrial activity, and we think that broad industrial activity based on our channel checks, are improving materially. And lastly, the earnings growth relative to the valuation we think is very attractive.
Okay, next one is SolarEdge Technologies. What is it that you like about this one?
Well, SolarEdge, it's a company we followed for a very long time. And I think going back to your earlier question about, well, what does the Strait of Hormuz mean for sort of energy markets? What does it mean for the broader economy? This is a stock where there's multiple ways of winning in terms of the thesis playing out. The first one is the base business. They do residential and commercial solar, and they create inverters. So if you think about a world where power is going to be constrained because of the energy shock, this is a company that should benefit. And we've seen a stabilization in their base solar business, which is good. But the more interesting and exciting part for us is that because power efficiency is a critical component of data centers, they've partnered with a number of semiconductor companies, Infineon being one of them, to create transformers, solid-state transformers, which effectively allow data centers to transmit power in a more efficient way. So this is a brand new end market opening up for the company. And based on our numbers, looking out to 2028, when the next generation of chips which need these higher voltage transformers are going to be available, SolarEdge stands to benefit.
Lastly, Amazon is another company that you see some opportunity in right now. Tell us more.
Yeah, absolutely. In terms of Amazon, there are really two parts to the business. The first is the retail business, and there we're very excited because the margins, looking out multiple years, have sort of always been understated by the company and underestimated by the street. We think that on a multi-year basis, the retail margins are going to continue to expand. And it's not something that that came to us randomly. We look across our portfolio companies, and then we say, well, what products does this company offer that might benefit another one of our portfolio companies? So going back to Regal Rexnord, one of their key end markets is they have a potential growth driver in humanoid robots. And we think that could be something that could benefit the likes of Amazon. And if you think about factory automation, that's something where we think there's continued runway for Amazon's retail segment, which should drive higher margins. And on the AWS side, if we go back 5 years or so, we were talking about on-premise versus cloud computing. And the question was, well, when is cloud demand going to slow down meaningfully? In an AI world, that conversion to on-prem to cloud is only accelerating. We're seeing it in the numbers, and we're very excited about Amazon from a core holding perspective.
All right, we're going to have to leave it there. Julian Nono-Wamden, VP and equity analyst at Goodread Investment Counsel. Great to have you join us. Thanks so much.
Thank you. Thank you for having me.
Coming up, we will break down the latest retail sales data in Canada, and we'll discuss a big story south of the border as incoming U.S. Fed Chair Kevin Warsh gets set to be sworn in. That's happening today. Stay with us. Canada had a stronger than expected performance in the retail sector for March. However, the growth was entirely driven by higher fuel prices. Stats Canada says retail sales showed a monthly increase of 0.9%. So let's get some perspective from Bradley Saunders, North American economist at Capital Economics. It's great to have you join us. Thanks so much.
Thanks.
So you say the results that we're seeing ugly, but not as bad as you feared. Tell us more.
Yeah, I'd say that's fair. So as you say, there was a 0.9% rise in value terms. In volume terms, that was a 0.7% fall, given that almost all of that boost came from higher gasoline prices. But if we look back to where we were last month, it could have been the case that it was as large as 1%. So yeah, maybe not as bad as feared. The reason for that being, we knew what was going to happen to gasoline station sales. So it was a case of what would happen to sales in other parts of the economy. Would Canadian consumers cut back on discretionary spending elsewhere, given they were paying more for their gasoline? And we saw a bit of mixed evidence in that. So some areas, so furniture, for instance, we saw sales slipping. In other parts, like electronics, clothing sales are still doing fairly okay. So I think, on the whole, as I said, we saw this contraction in sales volumes, but as I say, yeah, not as ugly as feared.
The Bank of Canada announcing its next rate decision on June 10th, so it's actually coming up. What do you think the Bank of Canada will be looking for in the March data? Because obviously we've heard Tiff Macklem talking about, higher fuel prices and what that's going to do for the economy.
Yeah, exactly. They'll be looking for areas of weakness, say areas in which it looks like households might be cutting back in discretionary spending. I think what's important that the bank has been pointing out repeatedly since the Iran war started was that this is not the same backdrop which we were in 2022 when Russia invaded Ukraine and energy prices spiked as well. And part of that is that we don't have this post-pandemic surge in spending, fueled by stimulus. And so I think, as I say, they'll be looking for those areas of discretionary spending in the report and trying to find this evidence that although we have higher oil prices, we don't have the backdrop of a growing economy at the same time, which could lead to inflation becoming a more sustained issue.
Yeah, because you've also pointed out that advanced estimates for April paired with the CPI data suggest sales volumes were flat last month as well.
Yeah, that's exactly right. So it seems that the pickup in spending we saw at the start of the year back January, February time, now it looks like the Iran war has really put a stop to that.
What about the impact of tariffs and the war in Iran? How much will that weigh into the next rate decision, do you think?
It's definitely a factor. I mean, that's something we saw at, as you said, the latest Bank of Canada meeting, where I think the bank was not afraid to sound a bit more hawkish, perhaps. There was a talk of, if oil prices were to rise further and remain elevated, then even consecutive rate hikes could be on the cards. I think almost every time the bank said something on that part, it was then cautioned with, there is the CUSMA renegotiation coming up. There is a consideration of, where tariffs will go from here. And it's about weighing those two options up. I think the main point being, as I said, that the bank has been repeatedly saying, this is not the backdrop of 2022. The bank wants to be patient and wait and see how things are playing out for now. And I think that it has the economic conditions to do that for the time being.
For the time being, but how long do you think? When do you think maybe we could see a change, potentially a rate hike? I know some people have been saying not until 2027. Do you agree with that?
That's our view at the moment. Admittedly, in the last couple of months, things have begun to shift a little bit, particularly, as I said, given some of the more hawkish messaging from the Bank of Canada. I think we had the summary of deliberations from the most recent meeting the other day, in that they said, there was scope to be patient for the time being. So I think the next meeting looks probably likely to be a hold as well. It's a case then of when we get to July, what situation are we in with the Strait of Hormuz? Where is the price of WTI? I think that, it really is a case of if we're still around 100, then perhaps we could see towards, the third, perhaps fourth quarter, really. But as I say, it depends massively on where the war's going, which at the minute just seems so unclear.
Yeah, and artificial intelligence, too, really starting to reshape the North American economy. How do you think central banks are making assessments in real time with that in mind?
Yeah, it's certainly a big factor. It's something the bank talked about in its latest monetary policy report and sort of revising its long-run potential output consideration. It's the same we're seeing a lot in the US with, the incoming Fed chair, Kevin Warsh. It's a point he's been making similar to that was made during the dot-com era, that we have, in a period of a fast-growing economy, the fact that there is this new general-purpose technology which should massively improve productivity, that then could call for perhaps a lower neutral rate of interest.
Oh, yeah, I wanted to ask you about Kevin Warsh before we wrap up here. He's getting sworn in today as the next chair of the Federal Reserve. Of course, you know that. Your thoughts on the path for Kevin Warsh moving forward?
It would certainly be a tricky one. We still think that the Fed will stay on hold this year. We've been taking that view for a while now. Markets have shifted over now to expecting one hike. I think that given in a sort of a similar situation to in Canada, where inflation is very much, at the moment is not so broad-based, I think there is scope for the Fed to be patient for the time being. But I think when we saw the minutes from the Fed's meeting earlier this week, we saw that Kevin Warsh is inheriting a pretty fractured FOMC. I think he was going to struggle to make friends coming in anyway, given the circumstances in which he's come in and the difficulty around Jerome Powell choosing to stay. But I think for now, it does look like it's going to be a lot more hostile environment to him. There'll be hawks and doves arguing back and forth. But I think on net, I do think the Fed for now will stay on hold for the time being.
And then how does that really impact the Bank of Canada moving forward? Does it at all in terms of decisions that are made down south?
Historically, that certainly has been the case. I think in the last couple of years, we've seen, such significant shocks to the two economies. Had the pandemic, had the oil, now two oil price shocks. I think especially then when it comes down to the CUSMA renegotiation, given that we can have such sort of, contrasting fortunes for the two economies, it seems like the two central banks' path of interest rates really have, structurally come apart for the time being. So I don't think necessarily the Bank of Canada will take too much steer from the Fed for now.
Okay. Bradley Saunders, North American economist at Capital Economics. Appreciate your time. Thanks for joining us.
Thanks for having me.
Coming up, more on shares in IMAX surging today on reports that the theater giant is exploring a sale. Details after this. Shares of IMAX are surging today. There are multiple reports the film distributor is exploring a sale and has approached entertainment companies as potential buyers. IMAX's search for a buyer comes as premium theater experiences are growing faster than the overall box office. For more, we are joined by Bloomberg reporter Ryan Vlastelica in Chicago. Good morning, Ryan. Great to have you. Tell us exactly what's behind these reports of a potential sale for IMAX.
Good morning. Thanks for having me. Well, you said it right there. There's been a lot of growth in the large screen format, especially relative to more traditional kind of movie theater experiences. IMAX is really at the center of this story, and there has been some speculation that the company might be willing to put itself up for sale. I believe the report said it was talking to entertainment companies. Now, people I've spoken to and reports I've read have indicated that it is maybe more likely, just from a regulatory standpoint, that this is going to be a partnership with a large tech company rather than a Hollywood studio. But there's still a lot that we don't know right now. But at least at the moment, IMAX shares are up pretty nicely.
You're also watching shares of Lionsgate gaining as strong box office fuels results there. So continuing with this theme of box office results and just how that's impacting this sector. Tell us about Lionsgate.
Yeah, well, this has actually been a pretty good year for box office, especially relative to the past few years. Everything since the pandemic has been a little bit slower than it has been historically, but Lionsgate has had a pretty good quarter. It had the movie The Housemaid with Sydney Sweeney in it, then it had the Michael Jackson biopic. Both of those did much better than expected, leading to pretty strong results in the theatrical business there, helping their overall profitability and leading to a pretty nice pop also in that stock today.
And Zoom is another one that you are watching. It's jumping on results and a raised outlook as well. Tell us more about that.
Yeah, well, just like you said, pretty strong report all around, beating expectations in terms of profitability and revenue, a pretty positive outlook. We saw at least one analyst upgrade today. They also spoke about how some of their AI products are gaining traction there. So overall, a pretty strong report. Obviously, this is a company that did extremely well in the pandemic, fell back quite a bit in the wake of that, just following the sort of the normalization of growth rates there. And more recently, there's been some concern about what is AI going to mean for this business, software overall. Is this going to be a really disruptive force as far as software growth goes? But this report is one of the many reports that we've seen lately, kind of indicating that maybe things are a little bit stronger in software than people have been concerned about, at least in the time being.
Yeah, because I wonder, too, like when it comes to competition, I was going to ask you whether Zoom is really facing a lot of tough competition, or is that more the software and AI build-out that you were just talking about there?
Mm-hmm. Yeah, I think Zoom's historical business, the video conferencing thing, it's not like you're expecting to see somebody vibe code some kind of competitor to that. So at least at the moment, it doesn't seem like they're seeing too much negative impact on the growth from the AI-related companies. And this report here was pretty strong, like I said, raised outlook, giving people a little bit more confidence in at least what growth is going to look like over the rest of the year.
Okay, Bloomberg's Ryan Vlastelica. We'll leave it there. Thanks so much for your time. Coming up, since the start of 2026, Canada's labour market showed the steepest decline in employment since 2021. But our next guest sees signs of hidden resilience. Stay with us. Canada's media regulator has unveiled new rules requiring streaming platforms to devote a larger share of their Canadian revenues to domestic and Indigenous programming. Under the CRTC's new framework, online streaming services will be required to direct 15% of Canadian revenue towards supporting Canadian content. Traditional broadcasters will also see their minimum spending requirements lowered to 25%. And shares of CAE are down in today's trading. That's after the flight simulator reported profit in its most recent quarter that fell compared to the year before. The Montreal-based company also unveiled a plan to increase operating income by 30% or more by 2030. CAE says the strategy will include a greater focus on defense clients. And Tim Hortons is ramping up its Canadian expansion plans with parent company Restaurant Brands International aiming to open 80 new restaurants and renovate another 400 locations by the end of the year. The company says population growth and expanding suburban communities have created room for additional stores. The company and its franchisees are expected to invest a combined $400 million into the new additions. And we're watching North American markets today. The TSX now basically flat at this point. S&P 500 still seeing some gains today, up ever so slightly by 0.3%. The Nasdaq also up to start the day. Between January and April 2026, Canada's labour market had its steepest decline in employment since 2021. However, upon taking a closer look at trends in layoff activity, hiring intentions, and retirement, our next guest is seeing reasons to be optimistic. So let's get more now from Claire Fan, senior economist at RBC. Good morning. Thanks for joining us.
Thanks for having me, Lindsay.
Let's go into a little more detail about some of the trends you're seeing and why you feel there's some room for optimism here.
Absolutely. I mean, like you said, January to April, Canada in total lost over 100,000 jobs, which is quite gloomy as far as the headline employment counts go. But underneath the headlines, we're actually seeing some pretty encouraging details again, including layoff numbers that have actually been on a trend lower since October of 2025. So broadly, I think really today's backdrop in Canada's labor market can be broadly characterized very simply by low hire, but also low fire. So companies are not necessarily laying off workers. It's really just this environment of really stagnant hiring activities that's leading to rising unemployment because a lot of new labor market entrants, these are new graduates or people that have previously stepped away from the workforce. They're entering into the labor market, but the hiring demand simply isn't there.
Yeah, okay, so still pretty gloomy then. There's just not as many jobs. So what's the reason for the kind of low fire? Less, hiring at this point? Are businesses just not optimistic about the future, not sure where, investments are going to be coming from the next couple of months?
Yeah, I think that's certainly one of it. I mean, when you talk about different sectors and their performances, we do see job losses in the ones that are exposed to U.S. trade policies. So these include a slew of manufacturing subsectors, most notably in the auto manufacturing as well as aluminum production and processing. So there are actual soft spots where layoffs are happening. But on an aggregate level, again, it is that soft hiring sentiment. And to your point, it's just headwinds, mostly external. Last year, of course, the broader trade environment has been creating, as it still is creating and persisting a lot of uncertainty for businesses. And then this year, of course, we've heard, multiple reports from businesses in different industries reporting that their input costs are starting to rise quite significantly because of the gasoline price increases that we've seen since the end of February. So all these considerations are perhaps just adding or holding businesses back from posting that job posting that they were going to. And then but besides that, domestically, again, we do want to highlight that consumer spending activities, they've been quite strong and resilient pretty much throughout the course of 2025. This morning's retail sales data actually look a bit softer. A lot of that probably is coming through in the form of households seeing really, really high gasoline prices are starting to think or reallocate their spending accordingly as well. So we're still cautiously optimistic about the labor market outlook, pending, of course, everything that evolves around the Middle East conflict and by extension gasoline prices here in Canada and its impact on household demand and by extension labor market condition as well.
There's a lot of trickle-down effects here. I want to go back to businesses and how they're not hiring right now, because as you mentioned, in your report, you say businesses are expressing hiring intentions, but they haven't actually translated into actual job growth yet. So what needs to happen for these intentions to actually turn into new jobs?
I think just longer periods of really operating stability, which is hard to come by these days. And another factor that often gets lumped into the conversation of a soft labor market, particularly on the youth end, is the impact of AI and sort of what it's having on the Canadian labor market. Although I think a previous research by Statistics Canada hasn't really found any significant evidence of workers getting displaced. But I think speaking of soft hiring demand, that has to be one of the factors as well. Businesses are again seeing a lot of headwinds, seeing a lot of uncertainty in their operating environment, and they're also waiting maybe perhaps to an extent to see just how much productivity gains that they can get really from utilizing all of these new technologies, including the AI that are advancing quite rapidly these days. So I think all of these potentially are factors. Although, again, I think just a couple of days ago, we've actually seen some pretty encouraging data when it comes to the summer jobs market from Indeed Hiring Lab that's flagging signs of stabilization. So perhaps that take higher in hiring intentions earlier in Q1 is starting to finally translating to perhaps not quite the improvement in labor market or job growth that we're expecting or hoping to see, but at least signs of stabilization.
Weak hiring has particularly impacted young workers and entry-level positions. How much of this weakness is a result of a weak economy versus AI replacing these positions, which we are seeing more of nowadays?
Yeah, that's a great question, and it's a question that many economists are pondering these days. What we do know, again, the hiring side of things is extremely weak. Again, it's likely a combination of both those things. One is, of course, the cyclical trends when it comes to just a broader sort of softer external headwinds. Again, trade, oil prices, rising input costs, squeezed margins. All of these will be weighing on business hiring intentions more significantly in stepping into Q2. The longer oil prices stay high, the more pronounced these negative impacts will be. And then on top of that, of course, everything that we just talked about when it comes to AI as well likely played a role. So I do think it's definitely a combination of both factors. And that's also from sort of anecdotal experiences when we go out to talk to businesses as well. But it's just hard to disaggregate exactly which one's which. And speaking of aggregate or structural trends, on the supply side, there is another factor that's also, having a profound impact on Canada's labor market these days, and that is the change in immigration and slowing population that we've seen. Not necessarily a positive, essentially, because really sort of the slowdown in immigration, and these tend to be younger workers, younger labor supplies as well. So the slowdown there not only means the labor force will be shrinking, it also means the Canadian labor force will be older because of the lack of immigration as well. So on the labor supply side, there also are some constraints that are coming through. So when demand does pick up, like we expect later this year, there simply might not be a lot of available workers, especially more experienced workers to replace those that are currently retiring. So another trend that's structural that perhaps worth highlighting as well.
For sure. There's just so many different trends here to kind of keep in mind. So with all of those factors that you just mentioned, before we wrap up here, what are you going to be watching closely in the labor market throughout the rest of 2026 that might impact the year ahead in 2027?
That's a great question. So leading indicators are the things that we watch. So these include job postings, next week's SEF data as well for job vacancies is a great leading indicator for just general sort of relative demand supply dynamics in the labor market. And it is worth it to know to just the general public that are reading these headline labor statistics, immigration is having an impact on so-called break-even employment. That means Canada can actually lose some jobs this year and still have the unemployment rate broadly staying steady, or if not trending lower. So that is just to say that we all perhaps should be paying more attention to the unemployment rate statistic that's less influenced by some of these structural changes in the economy and demographic trends, including slowing immigration. And our forecast, again, cautiously optimistic. We're really anticipating some resilience in domestic demand and spending will support this gradual translation between higher demand to actual job growth later this year, and for the unemployment rate to start trending lower towards 6.3% by the end of this year. That is still our base case forecast, but I would say that risk towards that forecast is really towards the downside, meaning that, again, there are just simply a lot of headwinds externally that are playing out, and we still need to track them very, very closely to see exactly how sort of hiring demand will turn out later this year.
Okay, we'll leave it there. Claire Fan, senior economist at RBC. Thanks so much for your time. Appreciate it.
Thanks for having me.
Coming up, we've got hot picks next. We will zero in on 3 beverage stocks for your portfolio when we come back. Stay with us. It's time for Hot Picks, and today we are zeroing in on 3 plays in the beverage sector. So for more, let's welcome Nick Modi, co-head of Global Consumer and Retail Research at RBC Capital Markets. Good morning. Thanks for joining us.
You bet. Thanks for having me.
The beverage sector is a pretty expansive sector. I'm wondering, is there growth in it right now? Are there certain sectors within this sector that are doing better than others? Just before we actually get to your hot picks here.
Yeah, at a high level, the beverage category is growing. I mean, you have to really look at the nuances, right? Obviously, non-alc beverages is growing faster than alc beverages right now. And then within beverages, you have energy drinks that are just, growing double digits. I mean, it's incredible what's been happening with that category over the last year. More importantly, it's been growing for 20, 30 years. And we think we're still in the very early innings of that growth curve.
Interesting. I wonder what's driving the energy drink curve and just also the alcohol side of things. You say it's not growing as quickly. It is still growing, though?
Not really. I mean, most of the segments in the market, the big segments, beer is down, wine and spirits are down. Obviously, you have ready-to-drink cocktails and prepackaged alcohol products are doing better. They're growing. That's really the only bright spot in terms of growth across the category.
Okay, so let's get into it then. Speaking of energy drinks, Monster Beverage Corporation is your first hot pick. Tell us how much opportunity you really see here.
Yeah, I mean, I see a lot of opportunity. I mean, we've had a buy on Monster for, over 15 years. And part of our thesis is we think this is just the next mega global brand, right? When you think about the global footprint of the company, especially as Coke is its biggest distributor. Coke has the most expansive distribution network out of any company on the planet. And then the category itself is growing. Now, here's an interesting statistic. Energy drinks in the U.S. are only 10% of the carbonated soft drink category, right? So it's still reasonably small relative to the grand scheme of the carbonated soft drink category. And the reason carbonated soft drinks are so big is because people consume those products with food. Well, now with all the flavor innovation, energy drinks are now starting to get normalized as something you can actually have with food versus it just being, I have to study or I have to do an overnight trip in a car, so let me take some energy drinks. People are actually starting to consume these products with food. And so I think we're still in the very, very, very early innings of the evolution of this category.
Interesting. All right. Primo Brands Corporation, that's the next one. That's your pick for today. Tell us why you like this one.
Yeah, Primo Brands. So basically, they are one of the biggest retail bottled water companies in the U.S., and they are by far the largest home and office water delivery business. Packaged water has been gaining share of overall beverages for the last 2 decades, and I don't think that's going to somehow reverse itself, right? And so we think we have a really cheap stock that has, I think, leverage to a very good category with good margin upside, and they're coming out of a little bit of a turnaround with a new CEO, and we think that's going incredibly well right now.
And last up, the Coca-Cola Company. Is there growth in this sector as well? I guess maybe like the non-sugar side of things?
Yeah, I mean, there's growth. I mean, Diet Coke is back on a growth trajectory. Coke Zero is growing really strongly. Even full sugar Coke is growing. I think Coke is obviously benefiting from a lot of market share gains as well. Now we have FIFA and the World Cup, which Coke is a sponsor of. That's going to be a big activation event for the summer, as well as America 250. So we think there's a lot of opportunity for Coke and its bottling partners to really engage consumers and really keep some of this growth momentum going.
What is the biggest headwind, I guess, for some of these companies? And they kind of are probably all, I'm assuming, dealing with different headwinds, just given the diversity of this sector.
Yeah, I would say at a high level, right? Obviously, macro pressures. Right, gas prices going up is not a good thing for any consumption. So I think that's something that the entire industry is dealing with. I think you have some changes in how SNAP funds can be used. Right, the food stamps in the U.S. There's some certain states that are actually excluding some beverages from those programs. That could affect the overall category. And then obviously, like a lot has been made about GLP-1s I do think it's a marginal impact. I just think the market might be overestimating the actual impact it's having. I think the bigger issue that's weighing on these companies right now is really macro-oriented.
Are higher prices and higher costs really affecting these companies at the moment too?
They are, but remember, a lot of these companies are hedged or have contracts that actually extend towards the end of this year. So a lot of the cost pressures that we might see in the market based on spot rates may not actually hit these companies until 2027. And the hope is that the economic environment normalizes, whereas they'll have a little bit more latitude to take price in 2027 to help offset some of the rising costs.
What about water as a beverage? Where does that fit into everything?
Yeah, I mean, look, water is like, if you're worried about GLP-1s, and, like it's good to invest in a company that sells water. Again, like I said, for the last 20 years, or long as I've been covering this industry, which is over 20 years, packaged water has been gaining share of overall beverages. And I think that's going to continue, especially as, more and more science comes out that we as a nation globally are always dehydrated, right? We have like chronic dehydration issues. And then as the population ages, water becomes more important as well. So I feel like the water category is still in a really good spot. And what people might say, well, that's such a commoditized category, but guess what? The fastest growing segments of this category are actually the highest priced waters, right? And so I definitely think there's something here.
Very interesting. Okay, we will leave it there. Nick Modi, co-head of Global Consumer and Retail Research at RBC Capital Markets. Thanks for joining us.
Thank you for having me.
Coming up, E.L.F. Beauty stock is down 33% this year. But when we come back, we'll hear why the company has great confidence in the runway ahead as it forecasts sales approaching nearly $2 billion US over the next year. More on that after the break. Stay with us. E.L.F. Beauty saw a significant contribution from the Rhode skincare brand in the latest quarter, as Rhode accounted for 34 of the 35 percentage points of top-line growth this quarter, underscoring its dominant role in the company's performance this quarter. Earlier, we got perspective with E.L.F. Beauty CFO Mandy Fields. Take a listen.
We're really impressed with the momentum that we're seeing behind Rhode. They had an incredible quarter contribution. 34 of the 35 points of growth that we delivered was driven by Rhode. So very pleased with the performance that we're seeing there, and really across all of E.L.F. Beauty. I mean, for the year, we delivered a 25% growth year, our 7th consecutive year of growth, 29 quarters running.
Talk to me about the partnership with Survivor. It's apparently in its 50th season, which made me feel pretty old. And I saw the spot, the ad that you guys made for it, which is pretty brilliant, with one of the cast members camouflaging herself. What do you expect to get from this?
Well, I'm with you. I also felt pretty old hearing 50 seasons of Survivor. I remember when it first started. But I'm really excited that we were able to partner with them. This is just another one of those culturally relevant moments that E.L.F. found its way into, and we really are excited for what we saw there last night.
Just to that point, because it does feel like the way that beauty is now targeted in advertisements, it's all TikTok, it's all Instagram, it's influencers. This feels decidedly different. Is it a different audience you're trying to achieve? Have you kind of grown already on the social media influencer side, and this is something different? Are you looking for an older audience? What does this get to?
We're always looking to connect with our community, and our community is very diverse. I mean, we have, we're the most purchased brand by Gen Alpha, Gen Z, and millennials. And so if we can tap into the Gen X crowd a little bit more with this, we certainly want to be there for that community as well.
I want to just point out, producer Will Shaker reminded us it's not 50 years old. It's been 50 seasons.
Correct.
And they do 2 seasons each year. So
okay. That's right.
That's what I said. It's a measly 25 years old. And I mean, that's how old Danny is.
Correct.
In terms of the growth, Mandy, where do you want to get it regionally? I mean, how focused are you on the U.S. and how important is international?
Well, both are very important to us. In the quarter, we saw 75% growth in our international markets, 26% growth in the U.S. market. So both are continuing to be growth drivers for us. But if you think about E.L.F. Beauty as a whole, roughly about 20% of our sales are outside of the U.S. So international still represents a huge opportunity, particularly compared to our other beauty peers who can have 70% of their business outside of the U.S. So all eyes on international, and Rhode will be launching in the EU this fall, 19 countries. And so more to come there.
I thought it was interesting that your gross margin is about the same as NVIDIA's. Right? I mean, it's 73%. NVIDIA's 75%. With them, I get it. With you, how do you achieve that? Aren't you paying high costs? Don't you have to deal with tariffs? This marketing budget must be big. How do you get to those gross margins?
Our gross margins have always been something that we focused on. I would go back in the day, maybe 10, 11 years ago, we were probably around 47% gross margins. And each year we've kind of worked on those through our supply chain initiatives, through our innovation mix, and continued to strengthen those margins.
I don't mean to cut you off, but we're almost out of time. And I'm super curious about this because, again, enviable margins. But you also in your earnings noted that in some places you're reducing prices for more value-oriented consumer. What's going on there, and how do you keep high margins while cutting costs? And only about a minute here, Mandy.
Yeah, so we are always going to be focused on providing value. Really, the way E.L.F. has been architected, our supply chain is built as such so that we can provide that value to our consumers. And if you think about it, 75% of our portfolio, $10 or less, and we're just being very thoughtful about where the consumer is right now. And if there's an opportunity for us to get sharper on prices in a couple places, we're certainly going to do that.
That was E.L.F. Beauty CFO Mandy Fields. Okay, yesterday on Market Call, we were joined by Gordon Reed. He is president and CEO of Goodread Investment Counsel, and he was covering U.S. equities. These were his top picks: Apple, Celanese, and Visa. Today on the show, we have Martin Cobb. He is Senior Vice President and Equities at Lauren Steinberg Wealth Management, and we'll be taking your questions on global and North American equities. The CRTC is raising the cost for streaming companies to support Canadian content. CTV's Abigail Beeman has more on what it could mean for Canada-U.S. trade talks.
This will triple the amount of money streaming companies will have to pay when some are already battling the current rules in court, and the whole issue is a thorn in the side of Canada-U.S. trade talks. As part of an effort to bring broadcasting rules into the digital age, the Canadian Radio, Television and Telecommunications Commission says digital streaming giants such as Netflix and Disney will have to pay 15% of their Canadian revenue to support programming in this country. That was previously set at 5%, but no one has benefited from the money, which is sitting in trust while the streamers fight the decision in court. Meanwhile, the Trump administration has long railed against the Online Streaming Act, calling it a trade irritant on a list of contentious issues ahead of a July 1st deadline for a review of the Canada-U.S.-Mexico free trade deal. As for traditional private broadcasters, including CTV News, the CRTC has lowered the amount to 25% of revenues with a whole host of new rules about how that money is spent. The old amount was between 30 and 45%.
Okay, and with this news, Netflix being impacted quite a bit, obviously, as you heard from Abigail Beeman, facing higher costs under these new Canada content rules. And so we're watching shares of Netflix down quite a bit today. This is pretty much flat. Over the past year, though, if we take a look at that, it is down 25%. So we'll continue to watch Netflix down by 0.8% today. And we're also keeping an eye on North American markets, particularly the S&P 500. This is interesting. It's heading for its longest string of weekly gains since 2023. It's up today by 0.4%. The TSX relatively flat at the moment. The NASDAQ also up by 0.5 percentage point right now. And of course, we are watching the price of oil. As always, the price of oil is rising today once again after a 3-day drop. And this comes after the Iran-U.S. standoff over uranium, which is in particular focus today. And you can see that obviously is prolonging the opening of the Strait of Hormuz, therefore the price of oil up by more than a full percentage point. And then we're also watching the price of gold. It is edging down as the continued talks in the Middle East continue to keep investors guessing on rate paths and whether there's going to be a rate hike in the future. That wraps up this edition of The Open. Morning Markets is up next with Roger Peterson.